Do we need an emergency rate cut? That's the question on the mind of many investors this week as Japan's flash crash triggered a worrisome outlook for US stocks. What's extremely ironic and funny is, folks, that markets have recovered significantly from the flash crash we saw on Monday morning, sparking concerns of a global recession. And what's truly staggering about this is that this rally has not been supported just by retail investors, but has much more seen involvement from institutions. As it turns out, what happened in Japan was simply a stark liquidation event, as people were converting their dollars and assets into yen during the immediate and unexpected interest rate hike for the Bank of Japan. As was already pointed out by many folks, and it's become pretty obvious now, the markets reacted in sync to what was happening overnight through futures. There was really no real material impact on the fundamentals and US investors' perception of quality companies. Now, don't get me wrong, folks, there is still significant concern on whether or not we're going to achieve the soft landing many people have predicted, because economic data is showing us that PMI and manufacturing has slowed down significantly and that the US economy is not going to perform nearly as well as it did for the past 3 years. And what's more is that key indicators like the yield curve inversion as well as the SOM indicator are showing we're headed right in that direction. But the question that I'm going to answer in this video is whether or not this even matters to stocks today. You see, folks, it's pretty clear that the Fed made two huge mistakes: raising rates too late and now cutting rates too late. This is certainly a mistake they're not looking to rectify anytime soon because it could potentially interfere with the election. But markets are expecting them to take action sooner rather than later. If you look at Main Street jobs, as well as demand in the electronics industry and inventory levels, there is significant slowdowns we're experiencing right now. Bankruptcies are at all-time highs, and simply people are not able to pay their bills because of extremely high inflation and job growth that is simply not as high as the data shows. This has resulted in, as you can see, a record amount of cuts by global central banks, except for the United States. And as data is showing us, based on current scenarios, cutting those interest rates is not a bad thing for the stock market. And no, cutting rates won't increase inflation. And here's exactly why that's the case. As you can see, equities have historically performed really well after the Fed starts a cutting cycle, except for times when growth is weak, as shown by the line in orange. Whenever there is a recession or a recession on the horizon where growth stalls significantly to a point we're seeing negative year-on-year growth of more than 2%, yes, stocks underperform greatly because the Fed at that time is cutting rates in an emergency reaction to something that's going on in the economy. However, for 90% of the other scenarios, markets actually rally, which is typically the time when the Fed is cutting rates because of something that is not an immediate emergency. And well, folks, as anybody can tell you, right now we're not necessarily in an emergency, even though what happened earlier this week was significantly concerning. COVID-19, Lehman Brothers' collapse, or what happened in 2008 with the mortgage crisis, or 9/11, were significant emergency situations. But unless something like that occurs out of the nowhere over the next few months, there is a very likely chance the Fed is not going to cut rates in an emergency. And hence, stocks will still perform just as well. And guess what? Unlike what many people predict on social media, cutting interest rates isn't going to give inflation a boost anytime soon. And one of the reasons for that is this chart right here that shows wage growth still way off the levels of the pandemic. What people need to realize, folks, is the fact that inflation is not linked to the Fed funds rate. Instead, it is correlated to the M2 money supply, which, by the way, skyrocketed in the pandemic because of stimulus checks. You know those $1,200 bills and checks the government sent out to millions of Americans? Well, yeah, it turns out that's not a great idea if you want to persevere inflation. As you can see, every single time the green line has risen dramatically, CPI has followed by a lag of 2 to 3 months. This is the primary driver of inflationary forces, and the pandemic exacerbated this thing because of shutdowns in manufacturing that caused extreme glouts of inventory, which caused risk assets like crypto and even wage growth to skyrocket, resulting in this compounding effect of prices going up. But right now, that is not the case. Unemployment is rising and wages are falling. Credit card payments are at all-time highs and mortgage rates are at 20-year highs. Manufacturing has boomed and has resulted in a significant oversupply in many industries. This is a textbook sign of actual deflation, not inflation, which is exactly why the government needs to take action, and investors are trying to price that in with the performance of something like the 10-year note over the past few weeks. You don't need to look any further than what the yield curve is showing you. Whenever this curve is below the red line, it signals an extremely tight scenario from the Federal Reserve, resulting in extremely tight monetary policy and most likely a deflationary scenario, which is exactly why when that curve starts to uninvert, meaning interest rate expectations are starting to fall, a recession typically follows. But this time around, that recession isn't going to be nearly as severe as what happened in 2008 or 2020. Instead, it's going to be much more similar to what happened maybe in 1984 or 1992. And just guess what happened to the S&P 500 3 years following that. Yes, it was up big time. As usual, folks, that is just my take on the situation. So let me know your thoughts down in the comments section below. Take care.